Trading for beginners can seem complicated, even scary. I mean, it's high risk and make you lose thousands of dollars, but if you know what you're doing, you can also make thousands of dollars consistently. To help you do this, I'm going to show you a few things: how trading works and the one mistake you must avoid, the technical side of trading, how to mitigate risk and get out of a bad trade, and how to trade an asset using all of the above to make your first $1,000. This means you'll know exactly how to make a trade, and then you can even make your first one right alongside me. Ready? Trading is like investing, but supercharged. With investing, you buy and hold an asset like a stock or a currency for a long time, and you hope to make a large gain. In trading, you buy and sell assets over shorter intervals for smaller gains each and every time. A trader usually executes multiple trades per day, hence the term day trading. The goal of day trading is to take advantage of market fluctuations and human psychology to make a quick profit. You identify a small opportunity, get in, grab it, and leave before the door closes. Basically, if you think the price is going to go up, you buy an asset with $2,000 and then sell when your stack goes up to $3,000, and boom, you just made $1,000 in profit in a few minutes. In day trading, you'll be spending a whole lot of time looking at this. And if you're confused, you should be, because there's stuff going all over the place, up and down, but don't worry, I'm going to explain this to you later. Right now, though, I want you to take note of how wild and frequent the fluctuations in price are. This tells you one major thing. Day trading is high risk. Just as you can make money quickly, you can also lose money. Your goal in trading is to make small profits where you can, while minimizing losses. That is the most important part. Anyone can make a wild bet and just hope for the best. I'm going to teach you how to consistently make calculated, smart bets. There are a ton of ways that you can do this, many of which I'll dive into later, but one of the most common is looking for signs that suggest an asset is going to move in price. For example, let's say Saudi Arabia just declared that it's run out of oil. That's bad, but this will likely affect the price of oil. A skilled trader would see that, enter a position quickly, make a profit, and then get out. The less risky the opportunity, the better it is for you as a trader. The biggest trading mistake you can possibly make, which will lose you potentially hundreds, thousands, or even hundreds of thousands of dollars, is this: you let your emotions influence your trades. It doesn't matter how much you feel a trade is right, or how hyped your friend or the market is about a specific trade. That doesn't matter. It doesn't matter! If your trade is driven by emotions on any level, abort. Do not pass go. Get out of that trade. You must have a clear, rational trading plan that minimizes risk and makes logical sense. That's it. Emotions have nothing to do with this. If you're an overly emotional person and you feel like, oh, maybe trading's not for me, I don't know, maybe it's not for you. But if you're like, I think I got a good grasp on this, then continue watching the video. Now, yeah, there are other mistakes that you don't want to make, like making too many trades trying to chase profit, not managing your risk, or not diversifying your trades across different assets and markets. But for now, the single biggest mistake to avoid, one that will lose you money, is getting emotional. Save that for the movies.
You were my brother, Anakin!
There's no best time to trade. People will tell you all kinds of theories, but really, the only real best time to trade is when the market is most volatile and has the highest amount of liquidity. This will allow you to enter and exit trades with the most ease, which you want as a trader. And sure, some assets will have the most liquidity when the US and European markets are open and in session. But if that doesn't fit with your individual schedule, then maybe that's not the best time for you individually. That's important. What are you up to? You have a life, you have a job, you're a beginner at this. This trading thing is probably going to be a side hustle at first. It has to be sustainable and work for you. So in short, there's no secret. And I'd recommend you experiment with which time works the best for you and your trading schedule. There are a bunch of key terms that you want to know so that day trading lingo doesn't sound like this. And to save this video from being like a series of definitions, I'm just going to put them all on screen right now so you can pause this and return here whenever you want. Now let's move on to the good stuff. I know, trading can look super confusing, but the process of making a day trade is actually really simple, and I want you to know this up front. So even though I'm gonna do a full walkthrough at the end, take a look at me doing a quick trade. Go to your favorite trading app. My favorite for trading stocks is Webull. They're actually offering 12 free stocks right now for signing up. I'll leave them linked in the description, so check that out. And don't worry, we're also gonna cover crypto trading as well later on this video, but for stocks, sign up, fund your account, click the markets tab on the bottom, type in the ticker symbol that you're trying to trade. I'm gonna go with Tesla. Click trade. Now we're gonna do a simple market order for $100 and done. It's that easy. Now when you wanna sell, simply click trade again, then the sell tab, make sure everything looks good, and boom, you're done. Now, I did that just to familiarize you with how simple the mechanics are of executing a trade. I'll show you how to do this in more detail in a bit. There are a whole lot of trading platforms, so do your homework here, but for me, I like Webull for stocks and I'm currently using Bybit for cryptos. Bybit will also be linked down below with an awesome cash bonus of potentially thousands of dollars for signing up. I'm actually currently using Bybit for a trading challenge on our membership site Finova, and it's been great. There I'm attempting to turn $100 into $10,000 only through trading. I started this challenge just a little while ago, and I'm making small, safe profits like this 4% gain. And we have other coaches making profits all the time like this 27% gain and this 12% profit that turned into 25% in a single day. If you were on Finova, you would have had access to all of those trades in real time. Plus, we have live coaching calls to cover all of this stuff in greater detail. And we just launched a year-long full-time traders course that takes newbies and trains them step by step on how to earn a living from trading, all for an extremely affordable price. I am so extremely proud of this community. So if you want even more hands-on help, definitely join Finova below. Trading is quick and volatile, which means it can be high risk. And while we all have different levels of risk tolerance, I would recommend only risking 1 to 2% of your entire account balance on any one trade. This will help protect you from large losses. Even for my tiny $100 trading challenge, which is far smaller than my total account balance, I started by trading just 10% of that $100 to limit risk, so I didn't just get wiped out on a bad trade. Once that grows to around $1,000, I'll only use 1 to 3% of the balance for my trades. You have to be safe. What I'm trying to say is if you have a $10,000 account, you shouldn't be risking more than $100 to $200 on any one trade. That's important. There are way more ways to manage risk beyond that, such as trailing stop losses, which we'll cover later. But for now, just remember that 1 to 2% rule, because it will protect you, not if, when disaster strikes. Technical analysis is a tool that helps you become a more well-rounded trader. That said, as with anything in trading, it cannot predict the future. Nothing can, no matter what fortune tellers try to tell you. And of course, we have to do the obligatory, this video is not financial advice. And now that the lawyers are satisfied, technical analysis is doing your homework on a trade, making sure it's not a scam, seeing how traders are engaging with the asset, and using tools to give you more information to make the best trade possible. This all helps us estimate whether the trends that are happening right now, also known as the price action, will continue in the future. To do this, you look at price movements and use indicators to suggest when may be a good time to buy or sell your asset. So how do you get started in technical analysis? The first is the candlestick chart. A candlestick chart is a snapshot of how prices are changing. For some reason, this looked like a candlestick to me. A red daily candle tells us that for the day, the asset closed at a loss. And you guessed it, a green candle tells us that the price went up. But even more important is to look at the opening and closing prices. If the candle is red, then the closing price is the bottom end of the candle, with the opening price at the top. The opposite is true for green candles. The bottom is the open price, and the top is the closing price for green candles. This tells us a lot about what the market is actually doing, especially considering you can set candles to show prices per minute, per hour, per day, really anything you wanted to set it to. But the detail doesn't stop here. There's also the wick. Slightly less cool wick. These ones. They tell us what the highest and lowest prices were for the time interval in which your candles were set. So if you have a 1-minute candle, then the top wick, That shows how high the price went within that minute. Change it to a 5-minute candle and the wick will change to show the price action within that 5-minute time frame. Wicks can extend well beyond the closing price of a candle, meaning the longer the wick, the more volatile the market actually is. And there's also specific meanings for red and green wicks. Long wicks at the bottom of red candles show that prices fell to what many considered to be the cheapest price within that interval. Naturally, people bought back in at that low price, driving the price back up. Sounds great, but remember, long wicks mean more volatility, so things can easily go the other way. Short wicks at the bottom of a red candle, this means traders may be continuing to sell, so proceed with caution. For a green candle, a long wick means the price significantly exceeded the closing price during that candle interval, meaning traders may have thought that this was the top and decided to sell in order to take their profits. Again, a long wick indicates volatility and may suggest the price will fall. A short wick at the top of a green candle is common when the price is at an all-time high. Some say that this is a good time to sell if you're looking to leave the position. A good time to buy, according to technical analysis, is to buy when there's a red candle with a long bottom wick and a short top wick. But guess what? Before you think any of that is easy, there are red candles that look like perfect buying opportunities only for the price to tumble afterwards, meaning you'd lose money. And this is because there's no tools in trading that can account for investor sentiment. There's nothing that can predict that news event that just broke or investors freaking out about some Elon tweet. So you always have to proceed with caution. If anyone tries to tell you otherwise, if they try to say that they're future tellers or they know exactly what's going to happen in the market, they're probably trying to con you out of some amount of money. Candlesticks and wicks aren't the end-all be-all of technical analysis. There's also trend lines. Trend lines are the practice of finding the overall movement in price, otherwise known as the trend. Now, many exchanges will have automatically generated trend lines that you can look at, but you can also create them yourself, connecting from the bottom of one candlestick to another. With enough points, you can project your trend line into the future to help you determine where the price may be headed. That said, you're going to want to compare multiple trend lines to get a better picture to help draw conclusions from. Support and resistance lines are horizontal lines that you can draw onto your price chart as well. Support shows the lowest price at which investors are willing to buy that asset, typically when there's the highest demand. If it's continually bouncing off of a specific price, that's its support. Resistance is the highest price at which investors stop buying and start selling instead. You can build your trading strategy around these points because there's a lot of action in between those points and they're pretty predictable. When lots of traders start doing this, you enter a situation called trading sideways. Trading sideways looks like this, and it means the price isn't changing that much over a period of time. For example, take a look at this chart, but the fun doesn't stop there. Formations show you the typical direction an asset is headed. Here are some popular ones that you may see referenced. This pattern could be referred to as a wedge pattern. If the trend lines had connected, it would be a pennant pattern. Flag patterns are two parallel trend lines that can head up, down, or sideways. A cup and handle pattern is when the price increase has paused. The bowl shape is then followed by what looks like a pennant chart pattern. This may indicate a further breakout in price. A head and shoulders trend following an increase in price may indicate the price will decrease. A reverse head and shoulders trend following a decrease in price may indicate the price will increase. Now, it's important to note that humans love finding patterns in all kinds of things, and there are a million different chart patterns that can mean a million different things, but this doesn't mean that expectation will always come true. Again, this just helps paint a more clear picture, but doesn't tell you the future. Using these to your advantage can be tricky. If you're a beginner, it's likely that you'll make a huge mistake, and let me explain. This image shows a price appearing to break through a formation. This is when most new traders will buy. But this is a mistake. The yellow circle is the moment this asset broke out of the formation, and it looks like it's headed for a trader's ideal price target. But this is the wrong time to buy, because this is where you need to be patient and wait for what's called the confirmation bounce, which is the green circle. The price bounces off of our resistance line and indicates the best moment to enter the trade. If it bounces to the upside, you enter a long position. If it bounces to the downside, you enter a short position. But not all trades are created equally, and to see why, you need to look at trading volume. Trading volume is the total dollar amount of assets that are bought and sold within a specific time frame. Higher trading volume generally indicates higher interest in a particular asset. Lower trading, the reverse, lower interest. When you combine this with trends, you get more information about how strong that trend actually is. Basically, the more money, aka trading volume, behind a trend,
8,000? No, this is impossible!
The more powerful it is. For example, two trends might look the same on a candlestick chart, but if one had $1 million in trading volume and the other had 10 million in volume, then the latter is a much, much stronger trend. Here's a tactic that you can use to help profit with this information. Monitor trading volume of an asset on days when the price went up and days when the price went down. If the volume is higher on positive days, this tells us that there's a potential for the asset to continue trending upwards in the future. This kind of information can help you know when to actually enter a trade, but when do you exit one? This may be the most important piece of trading because if you're a beginner, you'll be trading spot and not using leverage. In essence, this means you'll be using your own money in your trades rather than taking on debt to trade even more. So when do you exit your trade? Well, if you're just trading 1 to 2% of your own money, you won't have enormous losses at stake, which is great. This gives you a bit more leeway on when you can exit and you'll be far less emotional about those decisions. Remember, keeping those emotions as low as possible. It's such a major key, but here's the exit strategy. First, you want to have a profit target. This will give you a clear price level that you want to hit. It's super important to always go into a trade with a specific plan. Going back to that screenshot from the 27% profit trade, you can see that it says target 3 hit. That's because this coach always has multiple layers of target prices that he uses as stages where he can safely exit the trade. This is so extremely important, and you can even automate it using a stop loss order. This will sell for you once the price reaches a certain level, helping you to limit losses and helping keep those emotions down and away. Here's where you can set them up on Bybit. However, a stop loss can sometimes limit your profits. Let's say your stop loss sells, but then the asset keeps on going up in price afterwards. You could be missing out on some serious, super profitable trades. Because of that, you can also use a trailing stop loss. This is a dynamic stop loss order that adjusts to the market price as it moves in the direction that you want. So here's an example. Let's say you enter in a position at $1,000 and set a trailing stop loss of 10%. That means the stop price will be set at $900. But if the market keeps going up to, let's say, $1,100, the stop loss will then adjust to $1,000. So it's always 10% below the peak price, meaning you can only ever lose 10% from the highest market price. If you're trading a short position, this would be the same, but in reverse, with your trailing stop loss above the market price rather than below it. Here's a trailing stop on Webull for trading stocks. They make it super simple. Change the order type, and then you choose a percentage or a dollar amount that you want to go with. Let's go with percent and 5%. This means the app will automatically sell if the asset drops 5% from current levels, meaning if it goes up, we'll net new profit. If it goes down, we can only ever lose 5%. So a trailing stop loss can protect your profits while allowing you to gain much more potential upside. That's huge, but you still need to mitigate risk. There are a bunch of ways to lower your risk in trading. We've talked about a few of them already: stop loss orders, trailing stop loss orders. We've also gone through the big one, not getting emotional. Again, no matter how much you feel the price is going to go up or down or in any particular direction, you must ignore that and stick to whatever your trading plan is. Please keep the emotions down. If you learn one thing, that's it. But on top of that, you can also look at two different things. The first is market cap. If you're trading a crypto or stock, this is where you multiply the current price by the number of shares or coins in the market. The larger the number, the less volatile the asset should be, simply because it takes more money to move a larger asset. The next tool you can look at is the RSI, the Relative Strength Index. This is a figure displayed as a number between 0 and 100. 100. The RSI measures the strength of an asset. It compares recent gains to recent losses to see whether the asset is overbought or oversold. More simply, when the RSI is over about 70, that's typically considered overbought. Below 30, it's considered oversold. And you can view it on an oscillator graph. Okay, but how can you use it? The first is for trade signals. If an asset is overbought, you could take this as a sign to sell. If the asset is oversold, this could mean there's a price increase right around the corner. Divergences between the RSI and the market price could also suggest that a trend is about to reverse. Likewise, if the RSI is rising alongside the price, it could suggest that a trend is quite strong. In general, the more tools that you master and utilize, the more you'll be able to mitigate risk on your trades. So let's do some actual trades. We're going to do a stock, then a crypto trade. The mechanics are very similar for each, but for stocks, you're going to want to make an account with Webull linked in the description. Get your free stocks, then find an asset to trade. We're going to check out ticker symbol AUR. But before we buy, we're going to set up some trend lines. We're going to do so on the top and the bottoms of the candles. We have kind of a descending wedge going on here with a support level at around $1.07. The price is currently at $1.25. We're going to use a limit order set at $1.25. A limit order means the trade will execute at that specific $1.25 price. Then after the order, we'll set up a trailing stop order at around $1.08, $1.07. We're looking for a target price of up around $1.40. After all looks good, we hit place order. After we place the order, that trade would then go down into either the working or the filled tabs. After we own the asset, we then go to the sell tab. This is where we set up the protection, and we change the order to a trailing stop order. Then we enter in the distance between our price action and the stop price that we're looking for. In this case, that would be 18 cents less because the current price is $1.25, and 18 cents less than that will land us right around $1.07, $1.08, just below that support level. This again protects our downside in case we break through that support level. Then we click place order to set that up just in case. And of course, as the price goes up, that trailing stop will follow that price upwards, protecting our downside and securing that profit. Now let's do a trade in crypto using some slightly different strategies. Here we are on Bybit. Again, you'll want to make an account below, fund your account, and then go up to the trade tab up top, and then go to spot trading. On the search bar, you can type in any crypto ticker symbol. But right now, we're going to check out the biggest movers in the last day and see if there's any action. This Apex coin has been doing quite well, so let's check it out. We're on the 5-minute chart right now, and remember that means each candle represents a 5-minute interval. We're going to go up to the Trading View tab, which gives us even more options on this chart. Click and drag that sidebar to help adjust things if you need a slightly different view, and then we're going to draw some trend lines. In order to do that, there's going to be a little icon in the bottom left. Click that to expand the menu, give you way more options. Then click the line icon and place it across the tops of the candles. Then add a trend line on the bottom. Our target price is around 37 cents, near the previous highs within this specific trend. That'd be around a 10% gain in profit. We're going to do a small market order, which means we're buying at the current market rate. Even if that market rate changes a little bit, we're still buying. Click buy, and now we're going to set up a stop loss. Now this trade has a decent risk of dropping below that trend line, so we're going to set up a really safe stop loss at 0.339, just below the bottom of that support level. This will help again protect our downside risk here. That way we don't get into a bad trade and lose like 20-30%. The most we can lose here is just a couple percent. Then you can view that pending stop loss on the tab below, and you can see at what price it'll execute if the price does end up dropping. And now we wait. But that's really it. That's trading for beginners. You've got more to learn, but now you know the basics to go ahead and get started. Subscribe. Why is this so sad?